get excited into the discussion. Okay, I think we should be up on YouTube. I think so. Sorry about that. I'm gonna be monitoring my YouTube here. Okay, so welcome to the session this evening. We want to just spend some time together with you guys to be able to answer some questions that you are having. Then also for me to also sort of do a final walk through the syllabus about the various things that you have to focus on and speak on various other things that we have to look out for to be able to prepare well for tomorrow's corporate reporting and financial reporting examination. So it's a Q&A session, and you got to be specific. So if there is anything specific, there is something that you would want me to share my thought on, very specific, you raise your hand, I bring you up, or you put it in the chat for me. Then for those of you who are joining us on YouTube also, you can put your questions in the chat for me. Let it be specific, something that you would want me to speak to or share my thought on, basically, as we try to do a final wrap up for the examination. So we have begun. Any questions for me? You raise your hand, I bring you up, or you throw it in the chat for me. Like I said, I'm going to be answering your questions, and then some few things that I would just walk through the syllabus with you as well in respect of financial reporting and corporate reporting, so that tomorrow morning you'll be, well prepared for the examination. YouTube, I see you guys coming in. Put in the chat any questions you have for me. I'm going to be reading your comments here, monitoring your comments here, and I'm going to be answering you. Okay, so let's see. I have George. Yes, George.
Hello, Nhyira. Good evening.
Good evening, George.
Okay, so this is a not direct question though, but just want to understand the trend. Right from 2019, when the syllabus was revised up to date, for CR in particular, has there been any question on cash flow in terms of consolidation and then foreign subsidiary translation from 2019 up to date? Because I'm wondering, it appears it's for consolidation in particular, it has already been on either balance sheet and then either income statement and then balance sheet. Yeah, but I'm yet to witness a particular setting where we've had something like cash flow or foreign
consolidated cash flow is hanging in the mix. It's, I think, last 2 semesters it was brought in the FR class, cash flow statements. That was the first time it was brought, but in the CR environment that has not been brought. But the examiner has brought cash flow analysis before. That was, I think, 3 examination days ago in the mix. And when you are doing cash flow analysis, usually it's going to be from the consolidated perspective at the end of the day in that particular case. So if you're asking about cash flow, that's the mix. So that's the idea about that.
Oh, okay. Because actually, if you look at the consolidation, like you mentioned, it entails a lot.
Yeah.
Even with the acquisition step, comes with different dynamics, different kinds, and so forth. So, I mean, risking my time revising this kind of other subject, other topics, which is not an exam theory, I feel like I'm sacrificing my time for other things, of which I could have been concentrated much more on things I know that definitely by hook or crook is going to come. For example, the ratios, the blah, blah, blah. So I asked you just to seek for an advice from you as to whether I should completely ignore it or there's still a possibility that exam question might come from there.
The chief examiner, like I mentioned to you guys, like yesterday and on Friday, the ICA exam is getting interesting now. In other words, what it means is that if you are not somebody who has really studied, you're going to fail the exam. That's just hands down, because the quality of the exam, it's really increasing. So you cannot compare the exams now, where it is now, to the way they set questions in 2015, in 2014. No, the quality of the exam is getting better and better every time. So my take for you is this, like I said earlier in the Friday and Saturday class, console is a lot. Yes, we cannot overemphasize that. It's a lot. If you say you're going to be doing console, like I told you in class, I would have spent like 7 sessions, 3 hours, 7 to be able to do, and even that one I wouldn't finish, because if you watch the consolidation masterclass on the portal, you realize that that was like 6 sessions or so, and all those sessions were like 3-hour sessions. Some are even more than 3 hours. So console requires a lot of time. My take, as always, is that yes, it's important to have some ideas, it's important to have some knowledge, but then do not sabotage the 20 mark for the other 80 mark area. So really optimize yourself on the 80 marks. Ratios, we know it's going to be there. Ethics, corporate reporting, if the examiner is excited, he has been doing it. If he doesn't do it, he will bring some other theories there. There will be theories on consolidation, all other things being equal. Then the standards. Then corporate restructuring, financial reorganization, and business valuation mix. So yes, I will recommend, like I said, and I keep on telling you, optimize yourself on the 80 marks. And then spend a little time you will have left to do some things in consolidation and see, like I said, taking some easy marks, calculating your goodwill, which is always going to be obvious in every consolidated financial statement question in that case. So it's a lot, but it's just 20 marks at the end of the day. So apart from knowing about the theories in consolidation, like when there is negative goodwill, how do we account for it? 2, why is goodwill going to be negative? And we discussed some of these things. We said negative goodwill, what do? It's an income. It's a gain on the acquisition. So negative goodwill will then be recognized in the P&L account if we are preparing consolidated profit or loss. But if you are preparing consolidated statement of financial position, the negative goodwill, which is a gain on acquisition, will be added to the group retained earnings as is a gain on acquisition. So that is a treatment of goodwill. Negative goodwill, sorry. Then why do we get negative goodwill? Maybe because the seller is desperate. We've discussed this. Number 2, it could be because of the fact that the seller may not know the value of their assets. Number 3, it could also be better negotiation skills from the perspective of the buyer that could also result into goodwill having what? A negative amount. That is a theory the examiner can ask you. Another theory could be the indicators of significant influence. By default, we said acquisition of 25% or more of a company would give us significant influence. But in addition to that, having representation on the board gives you significant influence. And then having the right to participate in the financial and operating policies of the organization is also an indication for significant influence. And where we have significant influence, it means we are going to be using the equity accounting and account for it in accordance with IAS 28, investment in associates. Another theory is, how do we obtain control? And in accordance with IFRS 10, control can be obtained through the traditional means, that is acquiring more than 50% of the voting rights of the company. That's the default means of obtaining control. Nonetheless, there are various other means that the entity can obtain control. One is through arrangement with existing shareholders. So this is where the buyer entity has less than 50%, but has an arrangement with the other shareholders to transfer their ownership to the parent entity. That way, we obtain control. Another way we could obtain control is where the entity is in a position where there is a legal regulatory requirement, meaning that the law or regulators say that for this deal to be approved, you have to by default assume that you become the subsidiary of the company making the investment, because their company will be better managed. So I gave an example, like if MTN Ghana, it's a listed company, it has good corporate governance, it is better regulated. So if MTN Ghana today goes to acquire any shares in a company like Busy Internet or Surfline, if they are still operating, that will mean that there is going to be, the law can say, the regulators can say that automatically MTN will have to treat Surfline or Busy Internet as a subsidiary, although MTN will just acquire like 30% or 40% of the ownership of the business. So that is also another indirect way through which we can get control. So acquiring directly more than 50% of the company, or acquiring less than 50%, but negotiating with the existing shareholders to transfer their voting rights. Then also by regulatory requirements, we can obtain control. Another theory that the examiner can throw at us on consolidation is the issue in relation to the fact that when we have control, can we prepare consolidated financial statements? No, not all entities with control can prepare consolidated financial statements. So there are what we call exemptions from the preparation of consolidated financial statements. And the first one is that the entity doesn't have its shares or any bond traded on the Ghana Stock Exchange market. Then they cannot prepare consolidated financial statement. 2, the entity is not in the process of filing for their equity or debt instruments to be listed on the stock exchange market. That's the second reason. 3, the entity in itself is an intermediary entity where another entity prepares a consolidated financial statement in relation to that particular entity. That is another way of the exemptions in that case. So these are a couple of theories in consolidation that, depending on how excited the examiner is, it is something that he has been doing almost every examination, that it's spreading across corporate reporting and financial reporting. These theories that we discussed during the consolidated financial statement issues, you have to make sure that you understand them, because it could be a 5-mark question that the examiner will throw in there, or a 3-mark question that the examiner will throw in there. And like we say always, if you have seen 45 before, you've seen 47 before, you're not going to let 3 marks go at the end of the day. So yes, there is a lot on consolidation, but my goal for you is know the theories, go through them, have them very handy. Then the calculation aspect, remember how you calculate your goodwill. It's always going to be something that is obvious. Once you get your net asset at the date of acquisition, you can calculate goodwill. That's about 3 to 5 mark question, depending on the objective of the examiner for the examination date in July 2022. Then the rest of the items, read as you work. But before you get there, you might have taken all the theories first. Number 1, taking the ratios out. Number 2, come to corporate reconstruction, financial reorganization for corporate reporting students. Then for FR students, you can come to the single entity financial statements and the standards. So really, your deal for passing this examination depends on, if you want, 2 things: the accounting standards and ratios. That's the deal. The accounting standards and the ratios. Because financial reporting students don't deal 40% on standards, because you have a single entity. All the notes are accounting standards. Then you have a dedicated 20-mark question on standards. That's 40. Done deal. That is plus some other standard questions that the examiner will throw in the mix in question 5. So really, your ability to pass this exam is based on the standards and then the ratios. That's the way you optimize. So if at this point you still have problem with standards, I'm sorry, but it's going to be very hard. It's going to be very hard. So that is what I would say generally in response to George's question and concern that he raised as well. Any other thing for me? You raise your hand, I'll bring you up. What do I have? Good evening, sir. Please, can you slow down a bit? Whoa. Am I getting excited already? Let me know. Am I getting excited already? Am I rushing? Do you see me rushing? Very. Wow.
Yes,
that's strange. Okay. So I'm going to try to slow down. I thought sorry. Okay. Amina, sorry. I didn't know that I was getting excited already. Yes, George.
Okay, sir. Thank you.
All right.
Okay, sir. Thank you. Thank you for the advice. Now coming back to my main question of the day. First of all, number one, over the day I tried solving a lot of questions revolving around ratios, ethics, and then capital reduction questions. But I saw questions in different dynamics, in different ways, how they are being composed of. So my question on the ratio has to do with the testing of the ratios given in question. But at times the examiner might give you maybe an industry average, at times might compute a particular year ratio for you so that you also do the comparison, do the computation for the other comparison. I'm asking this question because of an experience I had some time ago. I think somewhere around that May 2021 or so. There was a
Okay.
particular ratio for CR, corporate reporting part three. No, CR ratio question. But then what we noticed was that as you test the ratios, the figures were not corresponding to the figures on the provided by the examiner. So we got confused. But let me say I got confused because I felt like, well, if I should use the same methods to calculate that of mine, I might end up getting the wrong figures altogether. So my question is it appropriate in such an instance to test ratios provided by the examiner, or you can just ignore and then proceed with your own calculation?
There is no way to test ratios. Let me mute you so that we can have the background noise reduced. There is no way to test ratios that has been given to you. There's no need to test it. All you have to do is to do your calculation. You just have to be mindful of picking up your figures. Yes, ratios are going to come from different shades, and we've solved a couple of questions in ratios. Number one, the first form of ratio is going to be the old school ratios, where you're just giving the financial statements of the company, and then you calculate whatever the heck ratios you're supposed to calculate, either for 2 years or better still, for just 1 year, because the examiner has given you industry average, then you do the calculation. Number two, the second type of ratio question that you can get is where the entity acquired another entity or disposed of a portion of their entity in the current year. So that will require that for comparison purposes, you will calculate the ratio for the current year, but you will also have to calculate another ratio for your interpretation purposes so that you'll be able to really look at the impact of the portion that has been acquired or portion that has been disposed of on the performance and position of the entity. That's the second type of ratio we can have. The third type of ratio we can have is where there is an incomplete records available to us. And then the examiner will give us a note, and we would have to amend the financial statements. Then we calculate the ratios. And all the notes that we are going to be amending are going to be based on the accounting standards. Again, at the end of the day. Then the fourth type of ratio that we can have in the exam hall will be the ratio in relation to where data is given to us, but then the examiner adds a note. For instance, if you remember, we said when calculating ROSI and gearing ratio, and there is lease obligation in the question, you have to be careful. And I want you to really stay with me carefully on this one. When we are calculating ratios and there is lease obligation, and there is a note that for the purposes of calculating ROSI, and then gearing, the lease obligation should be treated as interest-bearing debt. What it means is that the capital allowance calculation for ROSI, the capital employed calculation for ROSI and gearing will be different from the capital allowance you will use in calculating the assets turnover. So let me take that again. When we are calculating the ROSI and then the gearing ratio, we will calculate the capital employed. But the capital employed of these two ratios will include the lease obligation, both current and non-current. Why? Because the examiner may then state in the notes that for the purpose of calculating these two ratios, you have to bring the leases as what? An interest-bearing debt. But then if you go back to the asset turnover ratio, you will use your default way of calculating capital employed, which is total assets minus current liability. So that is also another exceptional type of ratio that the examiner will present to you at the end of the day. So in a nutshell, what I'm saying is that if we are giving industry information, we are giving last year information, we are giving whatever information, we can't test it. There is no way to verify it. Just focus on what you are requested to do and make sure you are picking the right figures. Make sure you are using the right formulas, and whatever answer you get, boom, you go away in that particular case. So there is no need to verify because you cannot verify. Just focus on what you are to calculate, and then you go away in that particular case. Once you are mindful of the formulas that you are using and the figures that you are using. Another thing that will bring issue is about inventory management. There are two formulas we can use. Inventory turnover days is different from inventory turnover. Inventory turnover days is different from inventory turnover. The inventory turnover, as you know already, is going to be the cost of sales divided by average inventories. Cost of sales divided by average inventory. That is inventory turnover. Now, the average inventory, like you saw the question we solved in class, is going to be opening plus closing stock divided by 2. But if we don't have opening and closing stock of inventories, then we're going to be just using the closing inventory. Then the formula becomes average inventory, cost of sales divided by what? The closing stock. And when we are dealing with inventory turnover, the answer must be left in what? Times. And the inventory turnover measures how quickly we are selling our inventories. So the higher the ratio, the better it is for the company. In other words, we expect that when we are using the inventory turnover ratio, the ratio should be rising or the ratio should be greater, which will indicate that the entity is selling the inventories as quickly as possible and not retaining a lot of the inventories to incur storage costs, obsolete cost, and also impairment of inventories, which will affect the net profit margin and the return on capital employed ratios. Then we can have inventory turnover period or inventory holding days. It's the same thing. If it is inventory turnover period or inventory holding days, that is the OG formula. So that's going to be average inventory over cost of sales times 365 days. And that one, the lower, the better. So when we are in the inventory holding days or the inventory turnover period, we expect the ratio to be lower, the ratio to be reducing, which means that the entity is keeping lower stocks of inventories, but then they are selling the inventories as quickly as possible. So that is also another thing that we need to understand when it comes to dealing with the ratios, especially about the inventory. If the question is quiet and you are just thrown in the mud to calculate the ratios, choose only one of these two inventory ratios that I've mentioned and calculate it and use it to what? Do your interpretation. You don't calculate the two. Then another thing is also the liquidity ratio. Sometimes the examiner will just ask you to do the current ratio. But like I told you always, when you are interpreting the current ratio, it is important to let the examiner understand that the current ratio doesn't show a true picture of the liquidity position of the entity. As such, it would have been prudent to calculate what? The quick ratio to assess the true liquidity position of the entity. That is, if you are not supposed to calculate it, you're not required to calculate it. It just is current ratio. Then you can use that reference when you are interpreting the current ratio, because that also increases the quality of your analysis and informs the examiner that you're good, your brain is there, you understand what the heck you're doing. Then finally, the gearing ratios. Remember, you don't just get up and interpret the gearing ratio as too high or too low, because according to Modigliani and Miller, and these are propounders of financial theories in financial management, advanced financial management, and all those things, corporate finance, they suggest that an entity can be geared 99.9% of the time, and there is no problem. So when you calculate the gearing, and 1 year it was 50, and the other year it's now 70, you don't scream and say, oh, the gearing ratio is too high, and no, because it is too high, the entity is very risky, they cannot go for debt. No, take it easy. To be able to reach that conclusion, we need what we call what? The interest cover ratio, which is going to be measuring the number of times the profit before interest and tax covers the interest expenses. And if the gearing ratio is rising, however, if the gearing ratio is rising, and because I want to just make sure I use the right grammatical expression, if the gearing ratio is rising and also the interest cover is rising, it tells you that although the company is borrowing money, they are using the money to acquire assets or invest into the business to generate more profit. So yes, the gearing ratio may be rising, but as their interest cover is equally rising, the entity may not have what? A long-term solvency problem, and they could be able to even get additional debt finance in the future at relatively low interest rate. However, if the gearing ratio is rising, but the interest cover ratio is reducing, is falling, it may indicate that the entity is borrowing a lot of money, a lot of funds, but may be using the fund to handle recurrent expenses like payment of dividend, payment of wages and salary or personnel emolument to the managers of the company, and that the debts are not being used to invest in the assets of the company. For that reason, it is likely that the entity will have solvency issues, and if they want to raise additional debt finance in the future, it's possible that they will raise that additional debt finance at a higher interest rate as the company becomes more risky than it is currently. That is the idea about that. So these are some of the things that we can talk about generally in the ratio. So really the problem here is, which formula am I supposed to use? How the heck can I get my figures? That should be your headache. And then when you finish, which formula am I using? How the heck am I able to get my figures? How am I going to analyze this in a manner that will be well understood? And I've given you a trick. If the examiner wants you to do the default analysis, meaning you're going to calculate the profitability ratios, liquidity ratios, and some gearing ratios, we've given you the way that you are supposed to go with the analysis. What did we say? Start with the asset turnover, the way the company generates revenue, right? When you start with the way the company generates revenue, the percentage increase in revenue, that helps you to then come to the gross profit margin so that we will know how much we are getting from the sales after the cost of sales. Once we are done with that, we come to the net profit margin that then informs us, because when you are explaining the gross profit margin, you make reference to revenue generation, asset turnover. Then you make reference to the entity's ability to be able to control or otherwise their cost of sales. Then you come to the net profit margin. When you are interpreting the net profit margin, you make reference to the revenue generation ability of the company, asset turnover, the ability of the entity to control cost of sales, gross profit margin, and then the ability of the entity to control operating expenses at the end of the day. The clue here is this: for example, if we realize that the entity is generating a lot of revenue and the gross profit is also rising, however, net profit is falling, what is going on there? Yes, the entity is generating a lot of revenue, but the net profit margin is reducing. What could be the reason? Pretty simple. It could be that because the entity is generating a lot of revenue, the entity may be incurring a lot of cost in distribution expenses, payment of commission to sales agents, as well as having a lot of delivery vans, which result into higher operating expenses in respect of their delivery van, as well as higher depreciation in respect of those delivery vans. And that is an assumption that we can use to do the analysis. And please, never make any definite statement in the analysis, because you are going to always be using assumption. So you use the phrases like this may be, this may be, this could be because, this may be because, but don't say this is because. That one you have judged yourself. What if it's not like that? Is it a deal? What if it's not like that? So don't make definite statements. Okay, you just say this could be, because you're going to be using assumptions in the question. The reason I want you to go with that analysis stage is that you can then confirm the statement you are making, so you don't lie. So when I'm in a net asset turnover and I make any statement, I'm making reference to when I'm in net profit margin, sorry, and I'm making any statement, I am making reference to revenue generation. I can't lie. I'm making reference to cost of sales, gross profit margin. I can't lie. So that is the deal for the ratio situation in that particular case. And this is going to be there. Like it's waiting for you there, whether I like it or not. So no matter what is going to happen, whether you are, and then the last thing, I think I nearly forgot this, is the choice of words you use. Please, I beg you. If it is the same company year on year, then you can use the OG words: increasing, reducing, rising, falling, sunshine, those things. You can say those things. If it is the same company year on year, you're good. You can say that. But if we are comparing a company to an industry average, or comparing the company to another entity, thou shalt not say increasing, reducing, rising, falling, because nothing is increasing, nothing is reducing, nothing is rising, nothing is falling. These are two separate entities. So what is the trick? You can say something is higher or lower, something is greater or less than, or someone performs better than other people. You know, you like to use those kind of phrases. This means that the entity performs better than, those KG2 English. But, it's your English. So just stay with your English in that case. So that is the last thing that I think you need to also understand when it comes to the interpretation bit of the ratios at the end of the day. Let the guidelines of the order in which you're supposed to analyze guide you, then the choice of words, because the basis of comparison would determines the choice of words that you're going to be using, as this one is higher, lower, rising, falling, mango, and then, orange. It's all in your hand. So that is the idea about the ratios. What am I having? I'm seeing a chart coming up. Can you take the capital employed formula again in relation to when there is a lease or no lease? Okay, so if there is a lease obligation in the question and the examiner said that the lease obligation should be treated as debt when calculating ROCE and then gearing, then what is going to be happening is that our capital employed formula will be the shareholders fund, anything under equity, plus interest-bearing debt, plus the lease obligations, both current and non-current. The lease obligations, both current and non-current. Lease obligation will be in current, will also be in non-current. The two, you're going to pick them up. When you add these three things up, that gives you the capital employed. And that is the capital employed figure you will use to calculate the return on capital employed and also the gearing ratio. But when you are going into asset turnover calculation, you won't use that formula. You will use the default formula for capital employed calculation, total assets minus current liabilities, because it will be stated in the question. So you just have to read that line and understand where you can actually put the lease obligation in that case. So that's the formula there for that. Okay, I see some of you guys coming up. You are welcome. It's a live Q&A session. So if you have any specific question for me, you can drop it in the chat or you can raise your hand and bring you up. And I'm also trying to expand on every key topic that we need to really focus on in the exam hall. Corporate reporting students under ratios, cash flow is going to be, sorry, I wanted to say going to be there. Like, I know the things, but I don't know anything. You may be asked to do cash flow analysis. All right. This has been asked before by the examiner, and we've discussed the way cash flow analysis is supposed to be done. So make sure that you go over that very well. It has been asked by the examiner just once. He could be excited about it in July 2023 and ask you about it. So beyond the things that we just spoke about and the ratios, make sure you spend some time on the cash flow analysis. I gave you a guidelines on how we analyze the ratios. We analyze the cash flow statement. And for those of you with my book on corporate reporting, there's a question there with solution there. And you can go through that again so that in case cash flow analysis come, and that's going to be a 15-mark area you're writing English throughout, no calculations for you if the examiner is excited about it. And that's for corporate reporting students alone in that case. So please make sure that you do that as well when it comes to dealing with the ratios. So I'm done on ratios. And I'm I'm done. Any other questions? Please, you raise your hand. I bring you up, or you put it in the chat for me. Does that matter whether the lease is finance or operating lease in relation to the same capital employed? No. Under IFRS 16, the lessee does not classify the lease into finance or operating. That's in IAS 17. So under IFRS 16, the principle we established was that the lessee, once we identify that there is a lease transaction, and we spoke about this in class, we said, number one, the lessee controls the asset, okay, directs the usage of the asset. Then number two, significant economic benefit from the use of the asset will flow to the lessee. So if these two are in that contract, then a lease has been established. Once the lease has been established, the lessee has two options: either to go by the default treatment, that is recognizing the lease in the books by debiting PPE and debiting right of use and crediting lease obligation. But then the lessee also has another alternative, that is the exemption approach, to use the low value approach. That is where the lessee would treat the leased asset as a lower value asset. So that way they would treat it as a normal rentals. So in that case, it won't even appear on the face of the statement of financial position. All the lessee does is debit P&L accounts for the annual lease payments and credits cash. So George, there is not going to be anything about operating lease or finance lease in the context of the calculation for the capital employed. It's either the company has the lease and it's on the books, and the examiner will make that statement clear in the notes, or they don't have anything like that. In that case, you just go by your default formula and you should be good. All right. Let me know if that is okay for you on that. Yes. Augustina.
Yeah, good evening, sir. Please, my question is under business valuation. When trying to calculate the net asset method, I realized that from a couple of questions, I realized that there are times that the adjustments in the notes, they were just added. Let's say if there is a revaluation gain, just the difference is being added to they just bring just the
Yeah.
And there are times that they pick the old figure from the statement and they less it from it. So I don't know at which point do you, because I saw one
relax, take it easy.
Okay.
Now, what's happening is that what is established in the footnote becomes what we are going to be using when we are determining the net asset and liabilities when we are valuing the business. So if, for instance, there is an asset on the face of the statement of financial position having a carrying amount of, say, 30,000. But then in the footnote, the examiner said, or there is a note there that says that the assets have a fair value of 35,000. We use what is in the note. So we will not pick the 30,000 there. We will pick the 35,000. Now, if you had already included the 30,000 in your schedule of workings, then you will only bring the incremental, which is the 5,000, and come and add it up. So the deal is that let the notes become a priority in business valuation. Then anything that the examiner or anything that there is no note about it, you pick that. Then also, there are certain things like inventory. They should be valued at lower of cost and net realizable value. So the inventory on the face of the statement of financial position is say 9,000. Then in the notes, we are told that the net realizable value of inventory is 12,000. Which one do you take? The cost which is at the year ended, because inventory must be valued at lower of cost and net realizable value. So the deal is about understanding the accounting implications of the notes on the statement of financial position. And sometimes you would have to pick what is in the notes or pick what is on the statement of financial position because of the context of what you are valuing or what you are determining. I don't know if that answers your question. Let me know. Augustina.
You're okay.
Which one is you okay? You okay is like, oh yeah, you've convinced me, but I'm not convinced, that kind of thing. Which one is you okay? All right, so let me see. Got some chats on YouTube. George Meyer said, good evening, please. I'm a new candidate and I wanted to know if I could use a health insurance going to the exam. Health insurance ID. Why don't you have an ICA? Health insurance ID, they accept you. At least take your Ghana card. Maybe that will be better. If you have a Ghana card, that's better. Maybe that's better. Health insurance ID, there. I think they said that data is it flawed or whatever the heck. So maybe take your Ghana card. That's better. If you can't get your whatever, you can't get your ICA ID. That's better. Ali said, good evening, Nhyira. Watching you from Bolga. Thank you, Ali, for joining us. Thomas said, please, can you throw more light on capital reduction and business valuation? Thomas, you've not asked any question. Can you be a bit specific for me? Throw more light on what exactly. Wish you well in tomorrow's exam. God willing, next year, we will surely take part. Okay, wishing you well in the exam. Sharifa said, hi, Nhyira. I've missed you, Papa, from Sharifa. Okay, Sharifa, thanks for joining us. Shepherd said, wow, you have it all on your fingertips like a piece of cake. Kudos, bro. Thank you, Shepherd. Amek Dekunu. Sharifa said, please, can you touch something on capital reconstruction? What should I touch on capital reconstruction? Okay, I'm going to do that. Okay. So Sharifa, you stay tuned because I'm going to be covering something about that. Yes, Stephen. Yes, Stephen. Hey, Ordana. Oh, okay.
Good evening, man. Good evening once again.
Yeah, good evening.
There's this question I was trying to solve on financial instruments yesterday. I think it's in our question kit, and I know the first thing to do is to split the proceeds into debt components and then equity components.
You mean you were solving convertible loan notes questions?
I don't know.
That is compound financial instrument?
Yeah, the question is here right now. I don't know if you yes. I don't know if you will permit me to read it for you.
If it is not too lengthy, because
it says
I just want to handle something specific.
Oh, it's not,
give me a sec. You said it's in the question kit. You said it's in the question kit. Maybe I could just open it and see it there.
Yes.
IFRS 9. Which question number?
Yes. Yeah.
Which question number? The guy's network is not good though.
It's Hiba.
What's the thing? What's a Hiba? May Hiba be your baby.
Hiba Limited.
Which question is Hiba? Oh my goodness. Okay, so what I'm going to do is, because your network is not, okay, you said Hiba Limited. I can't even see Hiba. So maybe what you can do is just snap your challenge and then put it on WhatsApp for me. After the class, I'll check and then deal with it for you. Okay, as your network is not stable. I learned you said it's raining where you are as well. So just send me the issue on WhatsApp after the class. Because I'll be available after the class, then I'll be able to handle that for you so that we can move on to something else. Hello, sir. For me, I have a lot of specific questions for you waiting for your course. Okay, so after the class, like after this session, you can give me a call and then we can handle those issues. Augustina, your hand was up. Are they? Johnny? Anna. Okay.
Yeah, please. This is on corporate restructuring.
Right.
What are some of the keywords or pointers that when we see, it will let us know that we are doing design or implementation, or because at times the examiner's questions are not too straightforward and you really become confused as to whether you have to do a design of the scheme and then in addition you do the implementation, or this is all about just implementation of a scheme. So is there any keyword or pointers for us to just know that, okay, this is what we have to do? Thank you.
Okay. In the corporate reconstruction, and I think Sharifa, if you're still on the call, I mean, I'm going to be addressing that together as well on YouTube from Sharifa. Corporate reconstruction, financial reorganization, it's an organic area. When I say organic area, it means that 99.9% of the time, everything is cooked for us already. So they've already designed the reconstruction. The issue is that the questions may come in twofold. So there is always a design for us. We're not going to be designing. In other words, we are not going to be put in a spot where we will be asked, what should the entity go for? Should they do debt exchange? How much should equity shareholders bring in place? Because that is about the designing. So the designing bit, it will be given in the question. But the examiner can come from two perspectives on the way the question will be asked. The first perspective is, if the entity goes into liquidation, what will be the position for the shareholders? What will be the position for the major stakeholders? So that is option one. So if the question, the examiner asks, bring that question, then he asks you, analyze the position of the investors or key stakeholders before the scheme and after the scheme. Then it means that, so that is a keyword. So you ask of the keyword and I'm explaining that. So if we are given the question, then the requirement is one, analyze the position of the key stakeholders before the scheme and after the scheme, or when the entity goes into the liquidation and then under the scheme. What do you do? In such environment, you have to go with option one, which is how much proceeds will the entity get when they ultimately dispose of the assets? Once you get the proceeds, you need to share. And if you remember, we said we're going to be sharing the proceeds in accordance with the various issues. So if there is winding cost, take it out. Number two, then we come to any regulatory payments that has to be made. Maybe they owe some GRA, some debts. We got to take that out as well. Then we come to secure debts. And there are two types of secure debt. We have fixed charge and then floating charge. Fixed charge are the debts that are secured on the assets of the company. So these kind of debts, we got to pay them first. But when you are paying first, you cannot pay above the fair value of the asset. And you have to be mindful of that. Then we have floating charge, which means these debts are secured on the whole company at the end of the day. So we pay winding cost, we pay any government bill, we pay for secure debt. Then after that, whatever money that will be left, we'll pay all of their debts, then we make the decision. So we will analyze the position of everybody when the entity goes into liquidation. Then under the scheme, what will be their position? And that is where we now prepare the new statement of financial position. And in every reconstruction question, like I mentioned in class, we are going to be preparing the capital reduction account. The capital reduction account is a control account to complete the double entry occurring under the reconstruction scheme. Because under the scheme, assets will be revalued. Some debts are going to be written off. Some exchanges are going to be done. Some people are going to be losing money. All of the corresponding entries will be made in the capital reduction account. But if the examiner should ask you, what is the maximum loss or gain that preference shareholders and ordinary shareholders will have or will share under the reconstruction scheme, that maximum loss or gain is the same as preparation of the capital reduction account. It's the same thing. So if the examiner makes that statement, then it's default. We are going to be preparing the capital reduction account. If the examiner does not, or revoir mesue, we're still going to be preparing the capital reduction account. Then when we finish, we'll prepare the statement of financial position. Then we will now analyze the position of the investors or the key stakeholders, under the scheme. Then we compare the two. If the company goes into liquidation, will all the secure debt holders get their money? Will all the preference shareholders get their money? How much will equity shareholders get? Then under the scheme, what is their position? Then that will help us to then conclude whether the scheme will be successfully implemented or accepted or not. And that type of question has been asked by the examiner once. I think so, if my memory serves me right, once. So that is the context of the way we're going to be having the capital reduction account question coming in. Sometimes there is nothing about liquidation. So all we are doing is implementation of the scheme. So we will not be asked to design the scheme. All we will be asked is, will it be acceptable? If we are asked whether the scheme will be acceptable or not, then we have to analyze the position of the major stakeholders when the company goes down in liquidation and their position when the company is reconstructed. So we won't design, but then that is the question we can be asked as to whether the scheme will be successful based on their position under the scheme and then when the company is liquidated. So that is the idea about the corporate reconstruction and financial reorganization area. I don't know if I addressed the concern that you raised about.
Yes, thank you. This one,
All
dear,
right.
yes, with a smile. Thank you.
Oh, really? So the first one I put you in a bottle. Come on, Augustina, I can't do that now. You cannot do that. You can't do that. Now, the final thing about reconstruction that I will just add briefly is that you got to be mindful about the language. And I've said this and I keep on saying it. Hold your breath. And you know what I mean by holding your breath. Read the question in sequence. You don't have to read the whole question before you start. Okay? Take it easy, step by step. I beg you. Do it like you can do it. Hold your breath like, I don't know, but hold it. So you don't read plenty, because the more you read, the more you become overwhelmed. Hey, I see. Oh, but the question is not difficult. So the last thing I would say about corporate reconstruction and reorganization is just pay attention to the context of the statement that I made. And also remember, goodwill, any intangible asset whose recoverable amounts cannot reliably be measured under the scheme, it's not going to be coming on the face of the statement of financial position, and we'll write it off and complete the double entry on the debit side of the capital reduction account. So any intangible asset whose recoverable amounts cannot be reliably measured, like goodwill, would have to be written off in the books under the corporate reconstruction or under the statement of financial position preparation. So please be mindful of that also in the presentation. Okay, so that is the idea about that.
Nhyira, please, last question on the, can you please explain to me reduce by?
Okay. It's English, right? When I say it's English, it's like I'm coming to laugh at you small, but it's English. So when we are told that, oh, the nominal value of the share capital has reduced to 10 Ghana cedi per share. Stay with me. So on the face of the statement of financial position, it's probably 15 Ghana cedis per share. So they said has reduced to 10 Ghana cedis per share. What does that mean? Reduced to means that is the new valuation. Reduced to means that is the new valuation. So if that is the new valuation, then we will use that to multiply the number of shares to get a value. So that the difference between the new value and the value on the face of the statement of financial position becomes the loss that will be recognized in the construction, in the capital reduction account. So reduced to means that is the new value you pick. Reduced by means that is the reduction from the old. So in order for you to get the new value, you have to take the by figure and from the value on the face of the financial position to get a new value, so that the difference becomes the loss that will go on the face of the capital reduction account. Let me take that again. Reduced to, it means that is the new value you will use to value the equity shares or whatever it is. Then the difference between that and the value on the face of the statement of financial position becomes a loss that will definitely be credited on the capital reduction account, because the journal entry will then be to debit the share capital or the share premium and then credit the capital reduction account. Then if it says reduce by, that means that is the gap. That is the difference. So for us to get a new value, we will go and take the old value on the face of the statement of financial position and subtract the reduced by figure to get a new value, which will become the new equity or the new valuation for us for whatever item that we are dealing with. Is that okay? Reduced to, reduced by. Hey, this girl, what is the for?
Because I was watching one of your videos when you were explaining this reduced to and reduced by, and that particular person had the share price was the nominal value was 10, and
right.
The question says preference shares should be reduced to 7.5.
Right.
So I think you even argued with one lady, she didn't understand like me now, and you were trying to explain it to her that reduced to, we have to use the value in loss, that's the 2.5 to work it.
That's right, because that is the loss coming in that will be debited to the capital account and credited to the capital reduction account.
So at what point do we use the new figure? Let's the 7.5. At what point, where do we use it?
Okay, so it's about two options. Reduce to means that the 7.5 is the new value. So what is the reduction? The reduction is the 2.5. So I could just pick the 2.5, multiply by the number of shares to debit it with the capital reduction, to debit it in the capital account and credit capital reduction account. Technically, the balancing figure will give me the value for the 7.5. Alternatively, I could pick the 7.5, multiply by the share capital, the number of shares, and that will give me the new value. Then I'll compare that new value to the value on the face of the statement of financial position to get a difference. That's the idea about the treatment on that.
Okay, thank you.
All right. Okay, so P said what? Let's see. Please, I suggest subsequently to please provide answers to the questions in the kits, because sometimes you solve questions and you don't know if you are right or wrong. Okay, oh, madam. But you could send it over for me to check as well. I've told you this over and over again, and I can't tell you the number of, questions and things that I've been handling especially from last week. And it's been interesting. I mean, people solve questions sent to me and I check for them. Some people have to have them on a call throughout in that case. So please, if you solve any question and something, just hit me over. And sorry, I said hit me over. That's not nice. Send it over on WhatsApp, and then I'll be able to handle it for you so that you know what you're doing. Okay. The premise for us not including the solution is that a lot of those questions are going to be given as assignments. Okay. And a lot of those questions are also going to be solved in class. And if you are given assignment from the kids and you have the solution, what's the value? So if you solve a question, you drop it, and then I can look at it for you. Does that make sense? Okay, Eric in the chat said, George, I'm coming. Let me pick some other people as well, so I will have equity. Otherwise, people will say, hey, Nhyira is just handling George, and Kwan like that. So, George, I'll be with you shortly. Eric said, please, in question, Agus Limited under business valuation, patent in the net asset valuation was divided by 10%. Please, why was it divided? Thank you. It is your question, Kate. Right. I think I remember that question. They said that there will be returns from the patent in perpetuity. I don't know if you remember that, Eric. The reason is that, like I was answering a moment ago, when we are dealing with the business valuation, the information in the notes is prioritized over the information on the face of the statement of financial position. So what happens in that question, if my memory serves me right, which it should, is that they stated that it is expected that they will receive a certain amount of money from the patent in perpetuity. And so when cash flow, the same amount of cash flow will be received in perpetuity, then we have to calculate the present value of that. And the present value of perpetuity is the cash flow that we will receive multiplied by 1 over R, where R is the cost of capital of the company. So Eric, if you remember that particular solution, you realize that we multiply the cash flow by 1 over R, R being the cost of capital of the company. And the reason we did that is because they said the cash flow is in perpetuity. And when you are receiving the same cash flow indefinitely, then you have to use perpetuity to discount it into present terms. And that will be the cash flow multiplied by 1 over R, and R is the cost of capital of the entity. Okay, Eric, let me know if that is okay for you in that case. Yes, any other questions? Some of you won't ask any question. You're just listening. You don't have any question. You'll be there and let others be asking their questions. Don't ask your questions. Then you'll be there and say, oh, Nhyira didn't talk about what I want him to talk about. How do I know that this is what you want me to talk about? Yes, George, what you got? Then I'll take some YouTubes as well. Yes,
okay,
George.
Nhyira, I have 2 questions under capital reduction.
Go.
After that, I'll hold my breath for people to come in before I move to business evaluation. So,
right.
First question on capital reduction. I met a question in ICAG Q&A manual, and then the requirement was to prepare a construction account. No, a capital construction account, something like that. But what is known, one of what is famous is the capital reduction account.
Right.
But to prepare a reconstruction account, that one seemed to be a bit strange to me. But in trying it, I applied the same principle of capital reduction, and I got it right anyway. But the challenge is, as part of the question, we're supposed to prepare journal entries for that. I finished that, but I realized that most of my entry was not correct. Actually, comparing to the answers, they weren't correct. What I noticed is that
double entry a week, Anna.
Not necessarily so. It appears like they bought the entries over there. What I mean by balking the entries is that, when you pick the debit side of the, what do we call it, the reconstruction account, then it totals everything and then send it at the credit side of journal entry, and then the total will also appear on as one figure for the credit entry. But I was actually looking at entering it one by one by one
individually.
Okay.
Okay.
Yes,
okay.
per every note. So I got confused as to whether if I should follow the same principle or if I use my approach, that one would be wrong. Or
once they say pass journal entries in respect of the transactions, then you need to pass individual journal entries like you have done at the end of the day. So you stay with that.
No, okay. And then secondly, on the determination of maximum loss, sometimes you see something like capital surplus, and then within earnings, having a debit balance.
Right.
So my question on the capital surplus is that in case you are preparing a capital reduction, of which we've been emphasizing almost all the time, that is the same as calculating the maximum loss. When you have any question like capital loss, do you treat the same way as you do for the determination of maximum loss, whereby the capital loss is used to reduce the liabilities or the cost aspect, or how do you go about the treatment of the capital loss when you are preparing the capital reduction? Does it appear at all? It doesn't come in at all.
Unless otherwise we are told that the loss as a result of the reconstruction will be borne by the ordinary shareholders and preference shareholders, we don't share. The figure will appear as a negative if it's a loss on the face of the statement of financial position that we are going to be preparing after the scheme. Did you get that?
All right.
So in the question, they would have to state that the preference shareholders said, like the question we solved in class, that the preference shareholders said they will, take part of any loss that will happen under the reconstruction. Unless that statement is made, whatever unless that statement is made, whatever loss we get will come on the face of the statement of financial position as a negative under equity. In that case, we won't share or write it off against anything.
Okay, all right, sir. Like I said, I will hold my breath for people to come before I come with other questions.
Right. Let's see. Please, I'm okay. It's true. It was in the perpetuity. Thank you. All right. So that was Eric. He said it's okay. Yes, Augustina, what you got?
Yeah, Nhyira. And please, the question I sent you this afternoon, I just want to go over again. In the footnote, it says that fair value adjustments should be deemed as temporary difference, which are subject to tax of 20%. And the fair value difference is 20. So they less it from both acquisition and reporting. But for the sub, they less it from just acquisition. So I just want to understand, at what point do you both, or
it depends on the context of the question. So maybe this is what you can do. Just send me a screenshot of the notes, because it depends on the context of the question. If there is a temporary difference and we have acquired a business, and as part of the fair value measurement, there is a temporary difference that has not been already be incorporated in the books, then it will come at acquisition and it will come at the year end. And deferred tax liability, if it's a liability, is a negative. So liability will be negated at acquisition at the year end. But if it's a deferred tax asset, it's a positive. Then we're going to be adding at acquisition and then at the year end. So possibly there is a note there that is causing the subsidiary one to just come at the date of acquisition. Maybe there is a note there. So maybe send me the notes after the class. I'll check for you and then send it over to you.
All right, thank you.
All right. What do I have? Please, can you explain the calculation of PE ratio method and earnings yield under business valuation? Right. So what we mentioned is that when we are valuing business, another method that we can use is the PE ratio, that is the price earnings ratio. Technically, the usage of the PE ratio means that the value per share is going to be equal to the earnings per share multiplied by the price earnings ratio. But this is the deal. The entity that we are valuing is going to be an unlisted company, an unquoted company. For that reason, we will need to get the PE ratio of a listed company, or PE ratio of the predator firm, or PE ratio of another proxy company. For that reason, we have to adjust the PE ratio. Now, the PE ratio tells us the future returns that we are going to be making from the entity. But this is the deal. Listed companies have guaranteed returns than unlisted companies. For that reason, listed companies will have a higher P ratio than unlisted company because of the risk. So we have to adjust the PE ratio. How do we adjust the PE ratio? We adjust the PE ratio downward using the risk premium in investing in an unlisted company. But sometimes the examiner will not give you that, so you use your own discretion. So let me give you an example. If the proxy firm has a PE ratio of, say, 10, and we are valuing a company, then we can adjust it downward by whatever, 30%. It's your discretion. It's your discretion. Between 1 to 30%, you can use it and adjust it downward. Why? Because the returns that we will get from a listed company is more guaranteed than unlisted company. That's how we deal with the PE ratio. So although the proxy firm has 10, the listed company has 10, we'll adjust it downward to be able to then multiply the amount adjusted by the earnings per share of the target firm that we are valuing to then get the value of the business. That is the PE ratio for the business valuation. But in the earnings yield, is the same concept. We are going to be using the earnings per share of the company multiplying by the earnings yield. But the earnings yield also, we're going to be having, how do we call it? The proxy firm. But you see, yield for listed companies is more guaranteed, again, than unlisted company. And it is risky to invest in an unlisted company than a listed company. So when you are using the earnings yield formula, that one we adjust it upward to build into the system the equity risk premium. What does that mean? It means that if for listed companies, the earnings yield is, say, 15%, then the unlisted companies whose value we are determining, we have to increase that value to maybe around 20%. Again, that is discretionary. If we are not giving the risk that the entity is associated with, then we don't have any chance. We can use 30% and adjust it upward. And then that adjusted figure now become the rate we will use to then calculate the value of the company. So the deal is this: price earnings ratio, proxy firm, adjust downward, value the business. Earnings yield approach, we adjust the formula upward because we have to put into the system the equity risk premium of investing in an unlisted company, as it is risky to invest in an unlisted company than a listed company. That's the idea about that. Amina, let me know if that makes sense. I think that's coming from Amina there in that case. Yes, Daxon.
Sir, good evening.
Yeah, good evening.
Please, I'm asking this because based on experience in teaching for quite some time, what is the best way to optimize the use of that 15 minutes reading time? Because I know that the rationale, best way we can optimize the use of the 15 minutes reading time. Because I know that it's the rationale is for us to plan, but I can tell you that it's also the bane of most students. So specifically, what are we supposed to use that time for?
Right. So that 15-minute reading time is for you to scout out the question. But let's be specific on corporate reporting and financial reporting. What you want to do in the 15-minute reading time is that, and I recommend that when even they say start work, take an additional 5 minutes and make it 20 on you so that you can, because in the 15-minute reading time, you can't write anything. If you write something, you're going to be not arrested, but you could be arrested, but you will not be arrested. They will come and take your answer booklet and give you a no one. So the deal is that you could add 5 minutes to it, making it 20. And then in the 15-minute reading time, what you're doing is just to go to the requirements of the question. Especially for corporate reporting, financial reporting, you go through the question and look at the theory aspect and look at what is coming in the theory. because we know what is going to be there in ratio, like ratio is going to be there, right? Then you know that there is going to be standards. So first, you can then scan read the theory aspect to make sure you have an understanding. Then you start remembering what are these things, because again, you can't write anything during that time. So the 15-minute reading time is for you to then scan through the question, but the focus is that you can look at those written aspects of the questions during that time. Then after that, you can go to the standards. Because the standards will require a lot of interpretation, you just read the requirements for now. So all the standards, you read a requirement to try to build your knowledge. Okay, what is this about? What is this requirement about? What is this requirement about? So that 15-minute reading time is for you to read the requirements. The reason why I say, even if they say start work, don't start, is because of the fact that you want to add an additional 5 minutes so that you can now write your thoughts. So possibly there are theories on how do we treat negative goodwill, or what are the exceptions to the treatment of to the preparation of consolidated financial statement. During that 15 minutes now, you can't write anything. So when they say start work, don't be in haste to start with that. Note those points down, and it could be in your answer booklet, the first page, you write answer plan there, and note those points down or scribble it down there. Don't write in your question paper because you will take it home. Nobody will come to your home and come and mark it there. Then you then extend the time. So technically, if they say start work, you can't start. Why? Because you don't have a deeper knowledge of what exactly is being asked in any question. So that is my take or my guidelines there. Use the 15 minutes, scan, read the questions, focusing on the theories, because you're going to have a couple of written questions, 15 or 20 marks, if the examiner is excited. Gather some understanding on them. Then if they say start work, extend that time a little bit to then read, so that you can then find out which of the questions can I do best first. If it is the written aspect, which is my recommendation, then you can then take out all the written aspect after your additional 5 minutes to really plan your thoughts and then write out your answers in that particular case. So that's my take on the 15-minute usage. Is that okay, Daxon?
Yeah, that's okay.
All right. Okay, Amina said, thank you, Nhyira. Okay, give me a sec. Let me see if we got something on YouTube here. Thomas said, hello, Nhyira. My challenge has to do with fair value adjustment under the subsidiary's net asset schedule. What items should come under fair value adjustment? Thomas, if you ask such a question, it's a little bit difficult for me to answer, because it's not about what comes under fair value adjustment. It's about what the examiner brings out in the notes. Okay, so it depends on the notes. So the examiner could say, oh, the entity, the fair value of the assets are equal to their carrying amount, with the exception of a plant which has a fair value above or a fair value of below. That means it's going to come there under the net asset schedule. 2, there could be a scenario that says that, oh, the subsidiary had capitalized something in accordance with the local GAAP that they are using. However, under the consolidation, the parent accounting standard must apply. So what they have capitalized, you have to now come and write off under consolidation. That requires an adjustment, and it will come under the fair value adjustment. So it is not about what comes there. It's about what is happening at the date of acquisition. And the key thing there is about knowing the standards. Because we can have IAS 16 under fair value adjustment. We can have IAS 37, provisions, contingent liabilities, contingent asset there. We can have IAS 12 coming to town there under the fair value adjustment, like the question Augustina asked a moment ago. We can have IAS 23, borrowing costs, because the entity may have written down off and expenses that they were supposed to have capitalized, because in their local GAAP, they might not be applying the full IFRSs. So it's not about what comes there. It's about what is happening at the date of acquisition. And it will depend on your understanding of the standards, Thomas. That's my take, because it's the standards that is playing out there. So it's not about what is coming there. It's about your understanding of the standards, and keenly what is happening at the date of acquisition. Because everything happening at the date of acquisition, it's a fair value adjustment issue that must come in the net asset schedule of the subsidiary in question. So Thomas, that is the idea about that. Sharifa said, please, is it likely cash flow console can drop? Oh, come on now. You can't ask me this question now. How can I answer that? I don't know ICA. I don't know the exam committee. I don't know anything. I can't say anything. Okay. If you are in the spirit and you are led in the spirit, you know, learn. Okay, so I can't comment on that, Sharifa, unfortunately, because I don't know what will come in the exam hall. Finally, then I'll come to Augustina. More especially whether the adjustment will affect only year end or both year end and acquisition. Again, it depends on the context. So let me give you an example here. Maybe they are supposed to write off an asset that they had capitalized. So at the date of acquisition, we will do that adjustment at acquisition. But if in the note we are told that this adjustment has already been incorporated in the books of the subsidiary, then it won't come again at the reporting date. Let me take this very well for you. There are some fair value adjustment treatment where the question will say the subsidiary has not incorporated the fair value adjustment in their financial statement yet. In that case, it will come at acquisition and come at the year end. But you know, any post-acquisition measurement like depreciation and all those things will come only at the reporting date. So if they have not already incorporated it in their books, then we bring it at acquisition and at year end. However, if we are told that the subsidiary has incorporated the fair value adjustment at the date of acquisition already in their books, thou shalt not bring it at the reporting date because it's already there. If the question is quiet, that neither have they adjusted or they have adjusted, then you assume it's not adjusted, then you bring it at acquisition and at the reporting date. So the key thing is reading the blueprints well, finding out what exactly is going on. If they say they have already adjusted for it, thou shalt not bring it at the reporting date. That's the key. That's the key. So Thomas, that's my take on your question in relation to the fair value adjustment and what will come at the date of acquisition and at the reporting date as well. Yes, Augustina.
Yeah, sure, please. When calculating the PE ratio and the business valuation, and the examiner, we do not have the PE ratio of the predator or the proxy firm, but then we have the market capitalization and the number of ordinary shares of the predator. We can use that to calculate the PE ratio.
Yes, then we will adjust it down to value the company.
Yeah, but I saw one question where they use the market capitalization and the number of ordinary shares. After that, then they divided it with the earnings per share from the predator. So which
Right.
is it complete?
No, relax. Market capitalization simply means the market cap of the company. So that is the total market value of the company. So if I want the value per share for the proxy firm, it will be the market capitalization divided by the number of shares. So that will give me the share price. But you know, PE ratio is share price divided by earnings per share. So that is the deal. Do you understand?
Yes, PE ratio. Is it divided or multiplied?
Relax. It's multiplied. Sorry, it's divided, right? Because the market capitalization is the total value of the business. So if I want share price or value per share, it's going to be the market capitalization divided by the number of shares of the company. That will give me the share price. That will give me the value per share. So that if I want the PE ratio, it's going to be the share price divided by the earnings per share. So once I get the share price, I'll now use that to come and once I get a PE ratio, I'll now use that to come and multiply the earnings per share of the target firm. Then I can value them after the adjustments.
Okay,
After the
please.
adjustment.
Where we do not have this information also, how do we calculate the PE ratio?
Ayeka. Enfa. Yen to me, like you should have a proxy data to be able to use the PE ratio. So if there's no proxy data available, then the examiner will not ask you in the first place.
Okay.
If it does, then that is a bonus question though. But he won't do that at this level.
Okay. Okay. All right. Thank you.
All right. Okay, seeing some charts coming up here on Zoom. Please, how is under or over depreciation treated when calculating NCI share of profit under consolidated profit or loss? I don't understand that. What do you mean by under or over depreciation? I don't get the context of the question. I mean, I don't know though, but because really it is the, yes.
Hello,
I'm
Nhyira.
listening.
Yes.
Yes.
Please, under consolidated profit or loss.
Yeah.
You see, when you are done with the net profit,
Right.
and you need the NCI share, you take the profit from the P&L given, and then where you subtract the PUP, depreciation, the impairment, that side is what I'm talking about.
Oh, okay. So,
if
go
the
ahead.
if the depreciation is out of the fair value adjustment,
Right.
you know that side we have either increasing or reduce the fair value. That's what I'm talking about. How do you treat?
Okay, technically, so your question is about first, how do we have to calculate the post-acquisition profit or loss. So if we are preparing the consolidated statement of profit or loss, then we have to calculate the post-acquisition profit or loss. And the way we calculate the post-acquisition profit or loss is just to bring the post-acquisition profit or loss, then any fair value adjustment. If it happens that in the fair value adjustment, they said all assets were equal to their carrying amount, with the exception of a property which had a fair value 3 million above the carrying amount, which means they have understated their assets, so we have to charge more depreciation. That more depreciation we charge would have to be subtracted from the post-acquisition profit or loss. So really, it won't affect the NCI directly because we would have to do those adjustments in the post-acquisition profit or loss. The final figure is what we will share to the NCI. So over or under depreciation will be adjusted for in calculating the post-acquisition profit or loss of the subsidiary, so that the net figure we get is what we now going to share or take NCI share when we are sharing the profit from the P&L account. So it doesn't affect NCI directly, but it will rather affect our calculation of the post-acquisition profit or loss at the end of the day. I don't know if that was the clarification you were looking at. So please let me know.
I'm not that clear, but then
so what I'm saying is that whatever it is, any fair value adjustment situation, over under depreciation situation, doesn't affect NCI directly. You have to adjust for that in calculating your post-acquisition profit or loss. So if you remember the questions we've solved in class, the last consolidated financial statement question we solved like this, we did a schedule for the post-acquisition profit or loss in arriving at the post-acquisition profit or loss. So whether they charge less depreciation or more depreciation, that additional depreciation figure doesn't go to NCI. It's added to the post-acquisition profit or subtracted from the post-acquisition profit. It is the net figure of that we would take NCI share. So it doesn't affect NCI directly. It's rather adjusted for in arriving at the post-acquisition profit or loss of the subsidiary, which is then shared between the parent and the sub. So that is why when he said in calculating NCI, no, in calculating post-acquisition profit or loss, that's where the depreciation issue will be affected, so that our net figure will be shared between the NCI and CI. So that is the idea about that.
Okay, so thank you. I'll look at it again and see.
Okay. Okay.
Thank you.
Richard said, please touch on share exchange under consolidated financial statement under goodwill. Right. So we said that as part of the fair value adjustment, as part of the fair value of consideration transferred, we're going to have share exchange. And we said that when there is a share exchange, it depends on the context of the question. But then share exchange means that the parent entity is issuing shares to the shareholders of the subsidiary, technically, as part of the fair value adjustment. So we're going to do our calculation. But the key thing is that you're going to use the parent share price in determining the fair value of the share exchange. We're going to use the parent share price in determining the fair value of the share exchange. But there is also one thing you must understand. If it is not already recorded, then that share exchange must be splitted between share capital and share premium when we are preparing the consolidated statement of financial position. The amount that goes to the share capital is the nominal value of the shares, which will always be on the face of the statement of financial position. And then the difference between that and the share price of the parent entity is the profit on the issue, which will go to the share premium account. But if they have already recorded it, then we leave it. If the question is quiet, doesn't say anything as to whether it's recorded or not recorded, assume it is recorded and get the hell out of there in that case, so that you can just get your fair value for the goodwill calculation, and that is all. So that is the idea about share exchange. Richard, let me know if that makes sense for you in that case. Okay. Thanks, sir. Okay, that's great. Thomas said, well noted, sir. Thanks. All right, Thomas. Thank God you understand that as well. Yes. Am I done? Can I go sleep? Am I even sleeping? Can you imagine that? Am I done? Can we go and chill? Sleep. Okay, sleep. Tomorrow morning, wake up, have your best breakfast tomorrow, some nice British, breakfast. Then you cruise, okay? Have a chauffeur drive you to the exam hall. Don't let poverty be on you tomorrow. At least let your brain be relaxed. Jumping from one throat to another, you are sweating. By the time you get to the exam hall, hey, I didn't always say Nhyira. Chauffeur yourself to the exam hall and relax, chill. That's all we need. Now, so the final comments that I'll make generally, if there are no other questions, is in relation to what we've said over and over again. Number one, take out all the theories first. My take for you is take out all the written parts, but just ensure that you don't answer the same question on this answer booklet. Okay, you don't answer the same question on the answer book on the same page. Okay, sorry, you don't answer different questions on the same page. As far as they are different questions, boom, take them out and answer those things. Number two, my heart tells me that ratios is not a miracle. But some people also have raised concern that Nhyira, the interpretation of the ratio, and sometimes my heart tells me if you're strong in the ratios, you could take that as fast as possible in the interpretation if you follow the guidelines that has been given, and we've discussed that again this evening. So take away all your theories, take the ratios. After that, corporate reporting students, you can go to corporate reconstruction, financial reorganization, or whatever the heck. Yeah, corporate reconstruction, financial reorganization, or business valuation. One of them will be there. If the examiner is excited, he can do 10-10 of the two. And that would be lovely though, but he has never done that. but it would be lovely for him to do it this semester. I don't know, maybe he can do it. So whatever. So you go to that question, answer whatever the heck is there. Then you can go to the standards. We've mentioned that when it comes to the standards, whether you like it or not, there is a non-current asset standards waiting for you. Minimum 3 of them will be dropping in the exam hall, all other things being equal. And you know the non-current asset standards, IAS 16, and we splitted it into initial measurement and subsequent measurement. So at the initial measurement with IAS 16, there is IAS 20 there, there is 37 there, there is 23 there, there is IAS 21 even there. Then we come to subsequent measurement. On subsequent measurement, there is 36 there, there is 12 there, income tax, and IAS 40 is in the mix. So you saw the way we learned PPE. The way we learned it together, that's the deal. There is a question on non-current assets waiting for you in the exam hall. Again, do not specialize in anything because all the standards have been examined by the examiner. All of them have been examined by the examiner. So you cannot say, oh, last semester this standards came, so this semester it won't come. You will be shocked because the examiner doesn't owe you any duty. Your take is be strong in the standards. 2, so that's about the non-current asset standards. 2, we've mentioned that IFRS 15, IFRS 9, IFRS 16, these are critical standards in financial reporting and corporate reporting. So the examiner is going to be excited. He could bring 2 out of these 3 or all the 3 if he wants to really get excited with students at the end of the day. So you want to make sure that you understand these standards well because they're going to be in the mix for you to be able to address them. Then for our level 3 guys, IAS 18 employee benefits and his brother IFRS 2 share-based payments. These are level 3 exclusive standards. There has been some examination dates where he didn't bring anything about them in the exam hall. And in that case, he just did everything in the level 2 standards. So you could have that shock. But if you go to the exam and you see that, don't take it personal. Don't take it personal. He will still bring you some standards that you are supposed to know about. But we expect the examiner that these level 3 exclusive standards, corporate reporting students, he's going to pay some homage to them and bring you something about them. The beauty of these standards is that it will also, or it could be dubbed in the consolidated financial statement. So as part of the notes to the consolidated financial statement, you may see IAS 19 there, employee benefits, or IFRS 2, some share-based payments, and it is the parents doing it. And so its implication on the consolidated financial statement is the same thing as what you know already in class. But if you go and there's nothing on these standards, please don't take it personal. The examiner is going to love you and he's going to have other standards coming in the mix and you're going to be okay. But exclusively, he may pay homage to that. Level 2 students, financial reporting students, I've told you already, there is a single entity question waiting for you. Either it will be cash flow or P&L and position. Whatever the heck the examiner brings, it's all about the standards. So in that mix on the single entity financial statement for 20 marks, each footnote is an accounting standard. What accounting standards are going to be there? IAS 16, you cannot go away from it. IAS 12, you cannot run away from it. IFRS 9, you cannot run away from it. IFRS 15 could be in the mix. IAS 10, events after the reporting period, could be in the mix. So you know the standards. Like, you don't have an excuse. Know the standards. So the order is take all the theories out, take the ratio out, then you come to the standards. Level 2 people, question 2, the final accounts question or the standard related question as well in that case. For level 3 students, after ratios, you go to the business valuation or corporate reconstruction. But again, it depends on how excited you get in the exam hall. My take for you is don't approach the consolidated financial statement question in the beginning of the exam. That's my recommendation. And see that I put my hand on my heart because you have to be able to hold yourself. You may see the question and read it and be like, oh, I can do this. Yeah. Before you realize you've spent 1.5 hours on that question. And that's why you start panicking. And when you start panicking, the blood in your head that flows to your brain doesn't go again. It's just going to be flowing here. Your heart is going to be racing. When that happens, everything you've learned is going to evaporate if you don't control yourself. So my take is, I'm not saying don't answer the consolidated financial statement question. If that's what you can do, I clap for you. Some of you can do it in 20 minutes or in 30 minutes. You know, I pray for you. You're going to be successful. But my general recommendation for you is, let that be your last but one question. And the deal there is, you are going for the free marks, especially no matter what happens, calculate the goodwill. Because for the goodwill calculation, you just need a fair value of consideration transferred. You need a net asset at acquisition. If you're able to deal with a fair value adjustment very well, then you can get your goodwill, because there is going to be an exclusive 3 to 5 mark question. Sometimes the examiner will be buying, calculate the goodwill at acquisition, 5 marks. That way, you're cruising through. So my take is, let that be your last but one question generally at the end of the day in the exam hall. But, you know, like I said, you are going to be in the soup. You are going to be in the environment. I'm not going to be there with you. So when you get there, be careful that you don't listen to certain things in your head, because your mind is going to be lying to you a lot in the exam hall. Oh, do this, do this. No, that's why I said, take your time to read the questions well. Because some of you, you are not going to be reading the questions completely and you will start. Only for you to get to the middle, then you get stuck. And that's why you start freaking out. So be mindful of what you are starting with. And if you get stuck on a question and you spend 2 minutes and you're still thinking about the treatment of something, stop it, go to the fresh page and go do something else. You cannot spend more time than required for any question, bearing in mind that each 1 mark, you're supposed to spend 1.8 minutes there. So if it's a 10 mark question, 18 minutes. If it's a 20 mark question, 36 minutes. If it's a 5 mark question, 9 minutes. And you have to be doing this. Yes, in some questions, you could extend a little bit. That is why if you take away all the theories first, you are likely to save some time so you can spread it on the other part of the questions. Then you can move at a pace. You cannot answer all the questions. That's the reality of life. But you have to be able to attempt as many as possible so you can pass the exams. But the reality is, you cannot answer all the questions. If per chance 30 minutes to stop work and you are now on your 3rd question, I don't know, but you know you have failed. Like, you know it from your heart that you are on your way to failure already. So control your time well, control your emotions well in the exam hall. Your heart is going to race. You're going to panic. Somebody is going to sit by your right side and the person will bend down, or somebody is going to sit at your left side and the person may not be doing anything, because when you're there, make sure that none of the reactions affect you. Because the person writing, if you're not seeing top, you feel like you have given up. The person not writing, if you're not careful, you will say, enye me nkwa. Enye me nkwa. Nah, unkwa na oba wiase, unkwa na obeko. So don't compare yourself to anybody. So make sure that you really control your environment. Let your mind be on your mind. Control your emotions. Stay focused. Take away the theories, do your ratios, then take away the rest of the things that you have to do. And that's my recommendation generally for you as you go into the exam hall. And I believe that what we have done, especially the time that we have spent on the standards, all other things being equal, you should be able to have the in-depth knowledge on the accounting standards very well, which is going to be 40% of the syllabus across board generally, because it's a significant portion. Even consolidation, there are standards there. Financial reconstruction, there are standards there that you have to deal with. Business valuation, there are standards there. You remember the question we did in PET, where we are supposed to revise the financial statement before we calculate the value of the business. These are standards. So don't just say, oh, I'm learning reconstruction. Oh, I'm learning business valuation. How about the standards as well? Because the standards actually walk through the entire syllabus. In ratios, you could be applying the standards, because I've told you, the examiner could bring a question where you are supposed to adjust the financial statement before you calculate the ratios. And the way you adjust the financial statement will all be based on your application of the accounting standards. Into your kosi say accounting standards, no, and one nebema wa pass it. That's the deal. That's the deal. So that's my take generally on that when it comes to what you have to do in the exam hall. And we pray and hope that you go in there and make yourself proud at the end of the day. Like I said, make sure you get to the exam hall on time. Make sure that you eat well in the morning, and just be sane and going in the exam hall. When you get there and your emotions are playing with you, like I've said this over and over again, for those of you who are spiritual, can just spend time, you pray a little bit and just some 30 seconds, 1 minute, being sensitive to the presence of God, presence of the Holy Spirit, and stay with yourself in that case. But 99.9% of the time, there is no devil after you. So you are the enemy of yourself. The devil doesn't know your address, okay? It doesn't know your address. The devil handles big things. You are not there yet. I'm not disrespecting you, but I'm just trying to tell you that if anything you feel in the exam hall is your own mind. It's not any my house people. No. Your house people, they don't know your address. They don't have time for you. Just focus. If anything, you are the child of God. What is in you is bigger than what is in the world. So how can your house people come after you in the exam hall when what is in you is bigger than what is in the world? So, because there's a spiritual aspect of all these things we are doing. It's not just physical. There's a spiritual aspect. So just have to be sensitive to that as well, but don't overdo it and be trying to do something thinking it's the devil. No, you are the cause of it. Just control your emotions, control your thoughts, and you'll be good in that case. All right. So that's it about that. I'm going to wrap up here for the live stream, but I'm going to be on standby. So if there are any things, you can drop me on WhatsApp. I'm going to be available to handle that, or hit me with a direct call. If you call me, because there are a couple of people who will be calling. If you call in, it's call waiting. Keep on calling. Okay. I'll be available, hopefully up maybe throughout the night, possibly, so that tomorrow morning I can sleep whilst you are writing the exams in that case. So I'll be available throughout to handle any challenges that you may be having. But please make sure you get some sleep. Okay? It's important. It's important. All right. So the Adaya Kosuyani Pitri. Yebe ende waha. And we wish you all the best. And hope to see the people graduating at graduation and people who have other papers to write in level 3. We will see you next semester in August when we resume. And we hope that it's been a great 12 weeks with us and you've had a good experience as well. So that's it. All the best. And we'll see you some other time. I wish all of you the best of luck. Okay, so Bernard is saying that we wish all of you the best of luck. So the best of luck to everybody. Bye-bye.